Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Investing in Dividend Stocks. And as the series name implies, this webcast is all about investing. And yet today I want to talk about times when some investors will actually act like traders, but only when they buy a new investment. I think this is going to be an interesting discussion. We might think that we are talking about two different worlds, but could there be some overlap between investing and trading? Is it misbehavior? We'll explore that. Before we get into that, though, let me first of all say hello to everyone who's already chatting in out in YouTube. Great to see a lot of familiar names out there. Hello to anyone that might be new, but hello there, Simone. We have Richard, Rojo, Kevin, Life in the Fast Lane, Eva, and everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you happen to be among those who are here for the very first time, I do want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recording. It's a great way to watch these webcasts, but you're certainly invited to join us in the live stream audience. And if you'd like to be here, this is a Thursday webcast series. We kick things off on our YouTube channel at noon Eastern Standard Time, or just let's say Eastern Time for this webcast series. Now, I also want to let everyone in the live stream audience know that my very good friend Kevin Horner is going to be hanging out in the chats with us today. Kevin's going to be keeping an eye on any questions that I can't get to just during the flow of the presentation. Kevin and I have been working together for years now. He brings a lot of experience to this. Great to have you there, Kevin. Thanks for having my back. Kevin and I would also like to issue an invitation to everybody listening, whether on the archive or watching live, to follow your favorite Schwab presenters on social media. That's really the only place to connect with us in between these live streams. So you can find us on X, you can find us on LinkedIn, you can find Kevin on X at Kevin Horner CS, you can find and follow me on X at Cameron May CS, or you can jump over to linkedin.com/in, and then again, /Cameron May CS will take you to my profile. Give me a follow there, and that's where you can communicate with me in between the live streams. But let's get into this discussion. And as we do, of course, first thing that we need to do is consider the risks associated with investing. Disclosures, these disclosures are important, so please keep them top of mind. This material is intended for general informational and educational purposes only. There are risks associated with investing in dividend-paying stocks, including, but not limited to, the risk that stocks might reduce or stop paying dividends. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so with all of that important information delivered, let's set an agenda for today's discussion. Of course, we're going to kick things off as we always do with a quick peek at the markets. We're going to look to see what's going on with our example paper money portfolio. We've fleshed out an entire example portfolio. We're continuing to keep an eye on that. And then last time, we started to build a brand new portfolio. So we're going to add to that new portfolio today. But as we do, I wanted to give some time to discuss why some investors, those that have that long-term investing perspective, might still recruit some techniques from the realm of trading in an effort to hopefully improve the performance of their investments. Now, typically this is only done on the entry of an investment, and I'll explain why. But we're going to be looking at things a little bit through the trader's lens as we make an example investment, add an example investment to our portfolio today, and we'll wrap it up. Make sure that we've built a new one. All right. It looks like people have had to reload YouTube. Yeah, if you're having any trouble, just hit refresh, reload. It sounds like YouTube might be having a little bit of a glitch, but it looks like at least that has addressed it for those that have done that. So let's get into our paper money portfolio. Let's go see what's going on with the markets. I'm going to switch here to our charts. Let's have a look first of all at what's going on with long-term bond yields. We look at this as sort of keeping an eye on the enemy. Now, I don't mean to say that long-term bonds are bad or inherently good. It's just that when investing in dividend stocks, there are other places that an income investor might choose to position their cash. And one of those places is in long-term government bonds if yields are competitive enough. So as yields rise, sometimes we'll see downward pressures on dividend stocks. It might explain why dividend stocks can flounder from time to time, at least to some degree. So what's going on with long-term yields? the symbol that we're looking at here is TNX:CGI. This is the 10-year yield on treasuries, 4.658%, down a bit from last week. We've sagged back a little bit on yields, which may be a little bit of a boost to our dividend stock portfolio. Now, this is only one potential variable. Of course, the individual companies can carry their own variables or pressures that might cause price to go up or down. Dividend stocks in aggregate may be influenced by broader economic trends or market trends. But yeah, we do keep an eye from week to week on what's happening with yields. Overall, yields really haven't been doing a lot now for about 6 weeks. You can see they've kind of stagnated. If I were to just sort of draw in highs on yields about here, lows have been about here, and you can see that we've just been sort of chopping back and forth. So likely not having a dramatic impact as we're kind of settling in. So we'll see what the Fed does in the future. We'll see if these yields maybe break out, continue to move higher, or if they start to trend downward. But let's go see what's going on with dividend stocks in general. So there is an index that we use to track the general performance of dividend-paying companies, but it's a little bit of a lengthy symbol. So follow along with me. $SPHYDMUT. I'm always proud of myself every time I get that in there correctly. Just so you know, a little insight into how my mind works. It's even a little bit intimidating for me typing that in front of an audience and getting it right. I don't think I've botched it up yet. I'll do it someday. Anyway, but this is the S&P Dividend Monarchs Index. These are S&P 1500 component companies that have been paying and increasing dividends every year for at least 50 years. And this is specifically a total returns index that shows not just what the average price or the aggregate price of those companies has done over time, but also it layers in all the dividends that have been paid. Typically, those are cut out of price performance. This indicator adds those dividends back in. And you can see dividends, yeah, we've actually been, dividend stocks have actually still been persistently climbing higher, with today being a bit of an exception, down about 1%, a little bit less than 1%. But overall, as yields have kind of settled in sideways, we've started to see those dividend stocks continuing to push higher, again, with a little bit of a pullback today. That might be explained for a number of reasons, but yields on long-term treasuries may be contributing to that. Anyway, but with that as a backdrop, now that we have a gauge of what's happening with the general marketplace for these things that we're investing in, let's go check on our overall portfolio performance. So if this is your first time in this webcast series, we have an example portfolio of $200,000 that we started investing on January, just at the start of this year. So January 8th was our first webcast of 2026. We started investing in example dividend stocks. And we put 5% of our $200,000 portfolio into now 20 companies. And we've done that very deliberately according to a stated set of priorities. Now, this is not going to be everyone's priorities, but among those priorities, of course, are going to be the dividends being paid, the yield that's currently being generated. Let me bring up my list. I always like to say it out in the same order so that it just keeps it consistent, a little bit easier to remember from week to week. But yield, diversification, consistency of payments, debt load is emphasized, the volatility of the stock that we're investing in, and the total performance of price plus dividends. So those are the priorities of this portfolio. They're just an example, not meant to be for everyone, certainly not meant to be an exhaustive list. Other investors might have different approach or a variation on this sort of a theme. But how are we doing? Well, so far, we've been collecting a yield that averages about 3.2%. Our beta, which is our gauge of volatility, has hovered around 73% of the of the volatility of the S&P 500. So a little bit lower volatility portfolio of what we've structured here. Our dividend payout ratio and long-term debt, we've tried to keep those below averages so that it's an effort for an investor, a dividend investor, to try to minimize risks or threats to the ongoing payment of those dividends. If a company has a lot of debt, and this is a topic that we're probably going to have to revisit a little bit later in the presentation, if a company carries a heavy amount of debt, it may prioritize the continuing servicing of that debt over the continuing payment of their dividends. So dividends can be cut if debt gets to be unbearable for the company. Now, finally, let's see what's been happening with our overall performance. Profit or loss since these positions have been established. Remember, one of these goes back to January. The most recent was just last week. But overall, up about 9.1%, in addition to maybe about 1.5%, maybe creeping up on 2% that's been collected in dividends, theoretical dividends. This is all paper money trading, but for the year. So overall for the year, probably on order of about 11.5 or 12% up. It's been a good 2026 so far. We'll see how this continues, but that's our original portfolio. Honey, too, you got through that YouTube, whatever that glitch is. Good to hear it. But here's last week's investment. Not off to a great start for this one. That's okay. A lot of these don't get out to strong starts out of the gate. But last week, we were looking for a little bit higher yield in kind of a low yield market environment out there. Yields are below 2% on average. So we invested in Abbott Labs. We got a 2.25% yield as of this moment. That's where the yield stands. Quite a low beta, about 58% versus the S&P 500. So lower volatility historically on Abbott, but this one's struggling a little bit. Maybe applying a little bit of a headwind against the overall performance of the portfolio. So what do we do with this? Should we jump out of Abbott? Nope. Actually, that's one of the behaviors that I want to talk about. If we were to exit Abbott this week after 1 week of investment, we kind of would just label ourselves more as traders than investors. And this webcast series is not called trading dividend stocks, it's called investing in dividend stocks. So I want to continue to flesh out this new portfolio. So this is portfolio A. We've got it all invested. We opened up an additional portfolio of $200,000. Started to build that out, so we want to spend another 5% today. But I want to do that by just kind of looking at this still, though, bringing in a little bit of a trader's lens. Okay? So let's talk about the pros and cons of doing that. Now, before we do that, though, we need to go find a stock to potentially invest in. Here's what I want to do. We're going to be using our scan. Maybe it'll be helpful. Let me share this scan again just quickly. Let's go to our scan tab. I'm going to load up the personal scan known as the dividend working class. And this looks through the S&P 500, filtering out our current dividend stock positions, but it's looking for stocks that seem to meet our stated portfolio criteria or priorities. So we'll go through that in a little bit more detail, but let me do this. I'm going to share this scan. Let's come up here. Let me click Share Scan Query. Oops, let's try that again. I missed. Go to Share Scan Query. And if we share like this, it creates a link that we can then like send to a buddy or a friend who also uses Thinkorswim who might want to use the same scan. But I've prepared this already. Let me just copy this from my session notes. I'm going to paste this into the chat window for the live attendees. For those that are watching on the archive, you can pop down below the video and you'll see down in the description, it'll say, here's my dividend working class scan. But let me send that in for my live audience. Just remember that shared scans are not guaranteed as to timing or accuracy. But let's go back and revisit this scan. All right. If I click scan here, what are we looking for? Well, we're looking through the S&P 500 for companies meeting our stated our portfolio priorities that I just outlined. We don't want to see a bunch of stocks that we already own, so I exclude our current dividend stock positions. I just have a watch list over here that I've created. So you'll notice this watch list, current dividend stock positions. I just added those 21 stocks that we now own, and they're just not going to show up in our scan results. But right now we are seeing about 43 companies. And we could just do what we've done in the past and just pick one. We could pick according to yield, maybe market capitalization, but just pick one in a sector we don't already have a lot of exposure to, and maybe just add that to the portfolio as an investment. However, I want to put on the trader's lens for just a moment. And to some, this might sound like misbehavior. We might think that investors and traders should behave very differently at all times. Well, not every investor actually completely ignores what's going on in the trading hemisphere of the investing marketplace. They might actually lean on some of those techniques. For example, maybe an investor might use some charting tools available to traders to gauge maybe, let's say, which sector out of the 11 seems to recently be gaining strength. We're going to buy into a sector anyway. We're going to hold that for the long term, but is it possible that maybe that investor might still, at least conceptually, improve the entry on the front end of this position? Hopefully. We're going to see. Long snapper, what do you say? You're back at the 6% max? Oh yeah, I did. Yeah, I set this. This is back to my defaults. Long snapper, we adjusted this upward. Oh, Joe, good question. Thank you. Thanks for asking. Every once in a while, I do things and I forget just a simple little step that's not obvious to somebody who's doing this for the first time. What Joe has asked is, hey, Cameron, you shared the scan link. What do I do with that link? It kind of looks like a URL that we'd go put into our browser and bring it up. It's not a browser URL. Instead, it's a link that only works within Thinkorswim desktop. So to load that up, the intended purpose of that link is to give you access to this same scan. All right. Now, to open that link or to import it into Thinkorswim desktop, we'll just go up here to where it says setup and open the shared item. I just shared an item. So you pop that link in here. So copy and paste it in here. If it doesn't seem to paste, hold down the control key and hit V, which is the same thing as paste basically. Anyway, paste it in here, click preview, and then import. And that will import this scan into your saved scans. So then to run the scan, you just come up here, go to load scan query, and go to your personal scans, and it'll show up right there. Is that better? Thanks for asking the question. Sometimes it's easy to overlook something like that. But again, getting back to that trader's perspective, I want to go to the charts for just a moment. And I'm going to load up a set of charts that I've constructed. I have a grid of the 11 sectors that comprise the S&P 500. And what we're going to do is just for a moment, look for emerging or apparent emerging technical strength for a sector. So I'm going to come up here and click on a little grid. Oh, actually, yeah, that's it. Click on the little grid and I'm going to choose sector strength. It's going to ask me, this current grid layout will be reloaded. Are you sure you want to load the configuration? Yeah. I'm going to click OK. And you'll see now, if I click on this grid, actually, if I click right here on this back button, you're going to see the 11 sectors that make up the S&P 500. And I just want to have a look at this one. So someone's asking, oh, CD says, where can I find the link just discussed to enter into TOS? Just look further up in the chat window. You might need to scroll up a little bit and you'll see a link that I posted. It'll say Trader Talks Webcasts. That's mine. Okay. But before I get too deeply into these sectors, let me share that grid. So I'll just share this grid. Let's call this sectors. We'll share that. I'll pop that in there as well. And then you load it in the same way that I just demonstrated. But in this case, instead of going to the watch list and finding it in your personal watch list, you'd go up here to the grid and load the grid. You have to load it up first. There we go. Anyway, so let's go through these. For today, I'm actually just going to review one. Let's take a look at what's going on with this very first chart. Can't even see what it is. These are the different sectors. There's going to be healthcare in here somewhere. There's going to be technology in here somewhere. I know where they are, but let's go to this one at the very top left. And what you might note is that this this sector has gone through periods where it's been comparatively strong. It's gone through periods where it's been comparatively weak, as it has over maybe 4 of the last 6, 5 of the last 7 months. But most recently, this is a sector that's appearing to start to gain some momentum at the moment. So I want to open up this chart and have a closer look. And when we've loaded a grid, we can do that by clicking on the little menu icon and maximizing this cell. Each of these charts are known as cells. So I'm going to maximize this first one. There we go. And what you'll see as I load that is a technical view of what's been happening with the energy sector. And down below, I've added a technical indicator known as relative strength. And boy, you might think, Cameron, this is feeling a whole lot like trading. We're not going to be doing trading today. We're going to be making an investment, but with the assistance of a trading technique. Does that mean that it's certainly going to be a better investment? Nope, it's not a guarantee. But for some investors, they'll still, once they've decided, you know what, I need to make an investment, I'm going to add something to my portfolio. Let's see if technical indicator might assist with that effort. So if you're not familiar with relative strength, here's what it does. It just compares whatever we have on the chart to the S&P 500 to see if it's acting relatively stronger or relatively weaker. I should say relatively more strongly, I think. But anyway, you get my point. And it does that. It makes that comparison with this line, this blue line, not the straight lines that I've drawn on the chart, but that moving blue line. If we see this blue line going down, the implication is for that period of time, whatever we have on our chart, in this case, it's the energy sector. If this blue line is going down, it would mean the energy sector has been underperforming the S&P 500 for that period that the blue line is going down. If the blue line is going up, it means the energy sector is outperforming the S&P 500. It doesn't mean, let me tell you what it does not imply. It doesn't mean that if the blue line is going down, that the energy sector is going down. Nope. It just means it's underperforming the S&P 500. So it's entirely possible the energy sector is going up, but the S&P is going up faster. So it's just one of those underperforming sectors. It's also possible the energy sector might be going down, but the S&P is going down faster. So in that case, our blue line would actually be going up, meaning the energy is doing better, or it's relatively stronger. So all of that's fine. That's great. But what some traders will look for as a behavior with this relative strength is they'll look for changes in direction. So you'll notice the energy sector was pretty much going sideways for several months. The stocks within the sector were also going sideways, maybe drifting a little bit higher, but essentially just matching what the S&P was doing during this period. But then there was a shift in that direction. We broke a trend line there. We broke through the highs of this sideways behavior. And for some, that shift in trend in the blue line might mean, hey, this sector is starting to outperform the S&P 500 in a way that might be more significant than it has been. And so maybe that'll lead to overall prices accelerating upward. In this case, that's just exactly what happened. Now, more recently, there was another shift in direction. Notice the energy sector is still generally moving up, but if you look at this blue arrow, the trend of the relative strength shifted, meaning energy sector started to underperform the S&P again. And subsequent to that, boy, it really kind of struggled. Overall, down to sideways. And we know the S&P actually had a great run during this period. So energy not doing as well as many other stocks out there. But what's happened again just very recently, within the last couple of months? Energy sector is again starting to outperform the S&P 500. And for our investor who doesn't really consider themselves a trader, that still might it might incline the investor. Well, maybe what I'll do is let's invest in the energy sector for now. It might not turn out to be the best investment. Risk is always present. No technical approach is going to erase all risk. But if an investment was already about to be made, maybe we'll do it with a little additional evidence. So, all right, so let's have another look at this scan, and we're going to modify this a little bit to go just to the energy sector. But just to revisit the logic of the scan, we're looking in the S&P 500 for companies that we don't already own, but that seem to meet the priorities, the stated priorities of this example portfolio. Now, those include yield. So we're looking for a minimum 2% yield, which is a little bit above the current average, up to a maximum of 6%. We've discussed in the past that very high yields might be a risk. That's perceived as a potential red flag by some dividend investors. If a company's offering a very high yield, it might be difficult to sustain that sort of yield. And a dividend cut can be very impactful in a negative way on a company's share value. So let's just say that our investor here is looking for a range in yield somewhere between 2% to 6%. Now we're also directing this to just those larger capitalization companies. You've probably heard of small, mid, large cap. Small is generally under $2 billion, $2 to $10 billion is mid cap. We're looking for large capitalization companies here. That's to address the volatility preferences of our portfolio. Typically, we're trying to look for lower volatility stocks, just in this example portfolio for those investors who prefer not to have a really sort of emotional roller coaster ride on their way from one dividend payment to the next. Beta serves a similar purpose. It's a gauge of volatility. Value of 0.5 means that these are stocks that would be about 50% less volatile on average than the S&P 500, up to 1.5, which would be stocks that are about 50% more volatile than average as compared to the S&P 500. And finally, we have a debt filter. Long-term debt to capital looks at the capitalization of a company. Where does its money come from? So let me do one quick thing here. There we go. But in any case, is their capitalization coming from common shares, from preferred shares, or from possibly long-term debt? What portion of that capitalization is coming from long-term debt? Now this one, I said we'd be talking about debt again. This is one that we need to revisit because we're going to be looking in the energy sector. And energy companies actually are typically pretty capital intensive organizations. They typically carry more debt than maybe some other sectors. Think about what an energy company does. They have vast distribution networks. Maybe they're laying big new pipelines through expensive fields. It can cost a lot of money to run an energy company. So we might need to dial this one up a little bit, but we'll hold off on that for just a moment. But we've already run our scan and we're finding a bunch of stocks across a range of sectors. There are a couple of ways that we can filter this just for energy stocks. One way is we could just organize by sector. So I can click on the outcome here, and this is going to go in alphabetical order, and energy happens to be the first one that pops up here. Actually, it's not in alphabetical order. Oh, I know what it did. We have to click on it a few more times. Click on it once, and it's kind of a little bit randomized order. Then we can go in ascending or descending alphabetical order. That's one way to do it. But another way is to just direct the scan itself to a specific sector. And that's what I want to do. Right up here, we're going to use the intersect with function. So for right now, we're scanning the S&P 500 for companies that we don't already own. But I want to say we want to scan the S&P 500 for companies that meet all these criteria that we don't already own, but that are only in the energy sector. So I'm going to choose intersect with, by industry, energy. And then we're just going to scan the entire energy sector. Select all energy. There we go. Now, when I rerun this scan, it's only looking at that energy sector, and it's highlighting the difficulty of looking for these sorts of criteria in the energy sector. And I think the one that's a potential hang-up is this long-term debt to capital, because these are just companies that generally carry more debt. So we might need to dial this up a bit. Let's take this up from 50%. Let's not go really a lot higher. How about 70%? So we're going to change that to 70 and rerun that scan. All right, it looks like we have 3 companies now. We have ONEOK, we have Williams, and we have SLB, formerly Schlumberger. Each of these are at least $10 billion companies. Actually, each of those outstripping that by quite a bit. Each of these paying dividends above 2%. ONEOK is actually up close to 5%. Each of these have long-term debt below 70, and each of these have a beta under 1, actually all hovering between like 60 and 75. So let's have a look at adding one of these to our example portfolio. And again, we're going to recruit a little bit of a trader technique, and that is we're going to go to the charts. Now, Ron and Duke Lou are saying we don't see your screen. If you're not seeing the screen, refresh your browser. Seems like YouTube has been having some hiccups. Hang in there, folks. It sounds like you can hear me. We're working on getting the stream to apparently unfreeze. Is that working now? There we go. Thank you, Paul. Thanks for the confirmation. So I'm going to backpedal just a little bit. I made a very subtle change here, a couple of changes. So just ignore what I'm doing. I'm going to clear this filter. I'm going to change this back to 50. Let's run our scan again. So we're looking at what we were before the screen had this little hiccup. But in any case, we're going to now change our scan to look in the S&P, yes, at our current position, look for stocks that we don't currently own, but we're going to direct that exclusively to the energy sector. So where it says intersect with, we're going to go to just that energy sector, all energy stocks, right? Now, the other thing you may have heard me say, you heard it audibly, but I'll say it again for the benefit of those that are watching on the archive, is this long-term debt capital. We're going to dial that up to 70% because this sector tends to be one of those sectors that has most companies carry a relatively higher debt load. So let's just enter that. And then as we run our scan again, now we're just seeing 3 companies. Okay, so we have ONEOK, we have Williams, and we have SLB. And again, as I said before, some of you might acquaint this with, it used to be Schlumberger Limited, now it's SLB Limited. But in any case, each of these companies are in that energy sector. They're larger companies paying higher dividends, lower volatility. Each of them are qualified, but now I want to go back and have a look at this through that trader lens again. Now, I've kind of snuck this in on you in the past, but what we've typically done is we look at a long-term chart just to make sure that at least historically, these companies haven't been undercutting the dividend investors' efforts to collect income by having a stock price that just refuses to go up. So we look at a total return chart over a long period of time to see if at least historically price plus dividends has been positive. So let's go to our charts and let's have a look at these 3 companies. So I'm going to take off, as we go to our charts, I'm going to take off that relative strength indicator. And instead, let's bring up, what was the first one? We had ONEOK, we had Williams, and we had SLB. That's right. So let's look at Williams. And I'm going to go to a long-term chart. Let's go to a 10-year weekly chart. And let's add in our dividends. Right now, this is a chart that's just showing us from left to right how price has done. And price is really, for at least for this company, it's gone from about 28 bucks to about 74 bucks. That's about a tripling of investor shareholder value. Not a guarantee of what the next 10 years holds, but at least as all these dividends have been being paid, the price hasn't been undercutting that income, right? But let's layer in the income onto our chart. A traditional stock chart does not show the value that dividends add. As a matter of fact, every time a dividend is paid, that is the stock price is reduced by that amount. So we're gonna add that back in. I'm gonna click on our little gear icon here, go to equities, and we're going to adjust for dividends to show all of those dividends that have been paid over the last 10 years, what impact have those had in addition to price. And you can see the line that I've drawn has shifted upward. That gap represents the additional value that's been contributed by dividends. So instead of this being an original $28 value, subtract out all those dividends, it's as though we only paid 12 bucks or so. So you can see that's a significant impact. But there's Williams. Let's look at the other two. Let's look at SLB. What has it done over the last 10 years? Well, it had a rough start. We had about 4 years where price really was undercutting income. But since then, mostly positive. And actually, more dramatically positive even than WMB. Barbara Hicks says, which other sectors would you adjust debt up, utilities, real estate, or maybe down, financials? Well, that's a good question, Barbara. I don't have time, my apologies, to get deeply into that, but maybe I might need to maybe put that in for discussion into a future webcast. It's a good idea. But really, SLB has been on a comparative tear over the last 6 years. Obviously, there was a 2-year exception right there, but overall, fairly positive. And what I want you to do as we look at these stocks, which one do you think we ought to add to our example portfolio? They're all in that energy sector, but I want to give you a glance at their long-term charts as well. Now, finally, we had OKE. We had ONEOK. This one, aside from, boy, this was about 1 week. Pardon me. This was about a month here. And then maybe, what, about 4 or 5 months here? Now, let's extend that a little bit further. Looks like about a year where ONEOK was struggling. But overall, 8.5, maybe close to 9 years of the last 10, it's had a pretty consistent performance. And for an investor, that might be important. Now, looking at charts, it is a little bit of a behavior technique that's more typical of, let's say, a trader, but we're leaning into that trading for our initial purchase. So let's look at let's throw it out there for my audience here. Which one? Let's cycle through them one more time. So we have WMB. Which one do we add to this portfolio? We have SLB. And we have OKE. Just chat in. We have 1 vote that has come in. Okay, as soon as I get 3 votes for the same symbol, that's the one that we'll add to our example portfolio. Okay, we got a second vote and a third, and all 3 of those were for WMB. Okay, so WMB is going to be our investment for this week. But guys, we've actually used some charts and we could have gotten a lot more particular. There's some investors who might use those trading techniques to get even more granular. They might be looking at charts on a week-to-week, possibly even a day-to-day basis as they're attempting to refine the timing of their entry. So all of that is sometimes done by investors, but usually only at the time of purchase. Why not at the time of exit? What do we become if we are investors who are using trading techniques on entry, trading techniques on exit. Similar timing. We're not investors, we're now traders. Really, what the investor has done here is just the primary purpose of the purchase is investment for the longer term. But even if we're going to be in an investment for a period of years, could it still add just a little bit of value if our timing's a little bit better? It could, it might. But I'll tell you, there are going to be specific reasons for exit as well, and none of those are going to be charting. The exits that we use in this webcast series include rebalancing. If we see one stock that's grown to be pretty large relative to the others, we might trim back that one a little bit. If a company's price has been going up and up and up and up, and the company hasn't been increasing the dividend to keep up with that price, what that can do is it can lower the yield. And if yield drops below average, we might consider selling that company, but only if it stays below average for a long stretch, because it might be a temporary price aberration. But if a company, for this webcast series, if a company's yield has dropped below average for more than 4 quarters, the company's not raising, they're showing signs that they're not going to change that dividend, we might decide to eliminate that from our portfolio and redistribute those funds to something that's generating a higher yield. Now, finally, if a dividend is cut. So none of those things have to do with what's going on with, let's say, support and resistance, our favorite technical indicator, what a candlestick is saying. Those are not going to play a role in the exits, because if we are trading on the entry and trading on the exits, we're just trading, we're not investing. All right. But guys, let's add a position. Let's go to our trade tab. Let's add WMB here. And with $10,000 to invest, let's divide that by 74.53. Obviously, we don't know exactly what we're going to pay, but we're going to buy 134 shares. Let's click on the ask price. Looks like price went up just a tick. So let's back off on the number of shares. Let's go for 133 shares. And let's say we're willing to spend up to 74 3/4 for that, 74.75. I'm just putting in a limit order to try to control that entry, not pay too much for the shares. Obviously, if we put in, oh, look at that, I clicked delete. Let's do that again. $74.75. Let's click confirm and send. So we're going to buy 133 WMB with a limit of 74.75. If we can get it for a lower price, the system will fill us at a lower price. If we can't get it at 74.75 or less, if your order just won't fill, no commission on this trade, but there can be on some types of trades. And we're going to send that order off. And all right, we bought that for 74.59. Yep, that price was going up as we're talking. Let's see if it continues to do that. But guys, that accomplishes what I set out to do today. I wanted to talk about how for some investors, they may actually employ even some trading techniques at the point of entry, but they've made the decision for investment for other purposes in most cases. In this case, we are looking at fleshing out a portfolio with stocks that meet a whole range of specified criteria. And then once we're ready to enter that trade, we use the charting technique to help us with the selection process for stocks in a specific sector. Now from here, we're back with our investing cap on again. We're not going to pay attention to what's happening with price. If it falls through a price floor, if a candlestick looks red, if a headline comes out, spooks us, those are not reasons for exit. In this series, we're waiting for, do we need to rebalance? Has the yield dropped below average for a long period, or has there been a dividend cut? That's more investing. All right. But guys, hope this has been an interesting discussion for you. Thanks for giving me your time today. I'm going to let you go, but just remember, as you move on to our other webcasts today, make sure that you're taking full advantage of our full range of educational offerings from Schwab, starting with our Trader Talks channel on YouTube. If you're new, welcome. Make sure that you've subscribed by clicking on the subscribe button down below the video. It only takes a moment to do that. Doesn't cost anything to subscribe. But our Trader Talks YouTube channel is where you can join our live streams. You can find our playlists of previous webcasts, and you can even do keyword searches for topics of specific interest through our webcast archives. Brent and I would also suggest that you follow us on social media. You can find us on X, you can find us on LinkedIn, but it's the place to connect with your favorite Schwab presenters in between the live streams. So for Brent, you can find him on X at Brent Moore CS. You can find me on X at Cameron May CS is my handle. And if you reply to my posts here, I try to reply right back to you. And as a matter of fact, your comments helped me with yesterday's webcast, where I asked what your favorite tools were on Thinkorswim. And those answers helped me build what is turning out to be a pretty popular video. So thanks for doing that. Now, you can also hop over to linkedin.com/in and then /Cameron May CS will take you right to my LinkedIn profile. And if you reply to my posts here, I just try to reply right back to you. All right. Everybody, thanks for joining. Go enjoy the rest of our webcast through the rest of the day. I will see you in a future webcast. I'll also see you on X and on LinkedIn, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy investing. Bye-bye.